Good morning viewers, my name is Vartik Chaubisa and I work as a quantitative analyst at Choice. Today we have here with us Mr. Chintan Haria, who's the product head and the head of strategy at ICICI Prudential. Welcome Mr. Haria.
Hi Vartik.
The term ETF has become quite popular in the market these days. Can you describe what an ETF is and how they differ from mutual funds for our new age investors?
Sure. So if you look at the evolution of investing in general, maybe in the West or in India also, people used to invest in single stocks directly. That used to be the norm. Then post 1990 in India, mutual funds started to become popular. People started to know what mutual funds are. In the last 10 years, mutual funds have become a synonymous with a household investment name, right? Everyone has some way or the other connected with mutual funds. And as part of investment within mutual funds, generally people invest in active funds where the fund manager is buying and selling on behalf of the investors and the unit holders. There is another category of passive investing, which is ETFs and index funds, which is becoming popular both globally as well as in India. And if I have to just explain what an ETF simply is, an ETF is an exchange traded fund, which is basically a passive instrument. If there is an index, let's say of top 50 names of India are packaged in a index form, and you have a product on that, let's say the ICICI Prudential Nifty 50 ETF, and you have it trading on the exchange. So the beauty of ETFs is in a single unit you can have exposure to those 50 names as part of the index, and there is no fund manager involved as such who is making active calls. It's basically replication of an index with an endeavor to give the investor whatever is the index return, that should be the investor's return in the ETF subject to whatever tracking error is. And these basically are traded on the exchange. So whenever there is market is open, and if suppose markets fall sharply and you want to participate, you get the benefit of real-time NAV, which apart from ETFs you do not get in any other product. So ETFs brings the objective or brings the element of investors being allowed to participate in real time and in single units, which makes it very convenient for even those who do not have very large sums of money to invest. One unit typically can be in the range of 50 rupees to 250 rupees also. So I think ETFs is a convenient, low-cost measure, and the number of ETFs as we move along we'll discuss have also, the opportunities have increased. So that's in simple terms what an ETF is. Index funds are like mutual funds which are participating on the passive side. So index fund is a different vehicle. ETFs are index funds which are traded on the exchange, to put it simply for anyone who is new to the market.
Wow, Mr. Haria, that was really insightful. I think I finally understand what an ETF is and how will that benefit our investors. So what strategy should an investor follow if they want to invest in an ETF?
Sure. So first of all, any investor, if you're looking at investing, the first thing that you should do is you should do your risk profiling with a professional advisor. That is always important because in India we are very, very cautious about our health. So we'll have a family doctor, but our financial health is equally important, and very few of us have advisors to advise us on the financial part, and that's where most of us get wrong-footed and make mistakes. So if you have an advisor, the first thing that advisor will do will see, okay, based on your responsibilities, your current income, your future potential growth of income, they will suggest a particular asset plan. Based on that asset plan, you'll have investments in active funds, passive funds, ETF, gold, silver, etc. And as part of that, then the strategy should be very simple. You first start with products which are simple in nature, market capitalization based. Then as you learn more and as the advisor obviously gains your confidence, you'll be able to then mature yourself into sectoral or thematic funds. And then of course the current, I think, growth area as far as investors are concerned is the smart beta funds, because smart beta brings an element of active plus passive in a way in ETFs, and we'll discuss that in detail. But from an investor standpoint, the strategy should be very simple. You should have a very well-balanced diet in terms of the funds that you're investing in. I believe the advisor should be there as part of those who do not understand markets, because there are so many variables and you cannot keep track on the market. So once you have your asset allocation plan, that how much should be in equity, how much should be in debt, and then you basically start building. Now, if you ask me what is a typical asset allocation plan that we would suggest, you have 50% in dynamic asset allocation plans like Balance Advantage Fund or any of the dynamic asset allocation funds in the category. And the balance 50% you can divide 10% into gold ETF, you can have 10% in international ETFs, and 20 to 25% you can have a mix of flexi cap funds or ETF, be it large cap ETFs or smart beta ETFs. I think that's a good long-term measure. The only thing is, whenever you're investing in equity, you should have a 3 to 5 year view. If you have a less than 3 year view, then you're basically playing a roulette, which is not advised from an investment standpoint.
Recently at Choice, we introduced a smart beta basket that contains two ICICI ETFs, which are the ICICI Prudential Low Vol 30 ETF and the ICICI Prudential NV20 ETF. What are the principles that govern their management?
Sure. So as I was explaining earlier, traditionally we had active funds. Then globally in 1960s or 1970s, the concept of index funds got launched by, I think, Vanguard, John Bogle, and the first index fund came in. So typically in India, if we see, you have the large cap based indices like let's say Nifty 50 or Sensex 30, and then you basically move on to the sectoral ones, right? Auto ETF, infrastructure ETF, IT ETF, bank ETF, private bank ETF, all these are available. Now there is this third element which is gaining ground, which is called the smart beta. It is gaining ground globally as well as in India. And what is smart beta? To simply put, smart beta is a way of selecting stock based on a price factor or a valuation factor. So simply put, you have many factors on which you can have selection of securities. What does a fund manager do ultimately? A fund manager, based on his style, whether it is growth, value, momentum, etc., will be selecting a group of stocks and then continuously monitoring it and changing it. That same concept has been brought into the passive funds or index and ETF funds, wherein through the smart beta route, you pick up a particular factor or a set of factors and select the 30 names or the 40 names which are there a part of the ETFs. Let's discuss the two names which you have selected in your basket in terms of the the smart beta combo, I should say. You have ICICI Prudential Nifty NV20 and the ICICI Prudential Nifty Low Vol 30. Both these products, in fact, are large cap in nature. If I have to speak of NV20, which is based on value as a factor, and Low Vol 30 is based on low vol as a factor. What are the various factors which are there? Just before I start speaking about the products itself, you have low vol, you have momentum, you have dividend yield, you have many other such factors which are possible, right? Within value, you could have something on price to earnings, something on price to book. Now let's look at the two funds which you've chosen in the basket, which are very unique funds in their own way. The first is the ICICI Prudential NV20. Now NV20, as the name suggests, is picking 20 stocks on the basis of their valuation parameters, and I'll describe the valuation parameters, out of the Nifty 50 universe. So typically, what is the universe? The universe is defined as the Nifty 50 stocks. So top 50 names in India roughly. Out of that, you have to pick 20 names. Now this exercise is done every 6 months. So like I was saying, it is a passive fund replicating a particular methodology, but active because every 6 months it does the changes based on the calculation. How are these 20 stocks chosen? The top 20 names on the basis of a formula. And what is the formula? 40% weightage is given to return on capital employed, 30% weightage is given to price to earnings ratio, 20% weightage is given to price to book ratio, and 10% weightage is given to dividend yield. So if you actually see any fund manager, if he is looking at a particular company, the return ratios like return on capital employed are important. The lower the price to earnings and lower the price to book, that's good from a valuation standpoint. And dividend yield ensures that the company is making enough cash flow to pay out dividends. All of this put together in the 40-30-20-10 ratio makes this a good product for investors, and generally we've seen the quality as it is. Nifty 50 stocks, the top 50 names are good in many aspects. The selection of this 20 becomes very, very nice because of the fact that you have valuation parameters and the highest weight is given to return on capital employed. And as you know, return on capital employed is essentially a good profitability metric, showing the quality of the company in terms of how profitable it can be. That's where this product is good for the investors. The weightage of this particular product in terms of how the 20 stocks are weighted is on the basis of market cap, right? Let's look at the other product. And this product has been already having a history of more than 6 years, as much as I can remember. The other product was launched somewhere in 2017 mid, which is the ICICI Prudential Nifty 100 Low Vol 30 ETF. And this is on a price factor of low vol. As the name suggests, low volatility are those stocks which are stable, right? We always say that stability provides a good long-term outcome. And within cricketing parlance, if I see the people who've been most successful, and since I grew up in the 1990s looking at cricket, and 2000 none other than Rahul Dravid comes to my mind. So if you look at the way he was steady in terms of how his performance was, in terms of not swashbuckling, but when any time that India has to win a test match at that point of time, or even one days, he was there to support the people who were swashbuckling. And if you look at his performance in terms of how steady he was, it basically ensured that in terms of the aggregate numbers at the end of the career, he stood right up there. I think he's in the top 10 in test, top 10 in one days also, if I'm not mistaken. So similarly, the concept of low vol 30 is very simple. You pick up the 30 stocks out of the top 100 names that are there in India. So the universe is top 100 names, large cap, liquid. Pick up 30 stocks on the basis of their lowest volatility, or in the last 1 year, which are the stocks which are the most stable, if I have to put it in simple words. You pick those stocks up. Then their weightages are also on the basis of the stock which is most stable will have the highest weight. And typically we've seen the weightages in the 30 stocks are in the range of 2.5 to 5.5% roughly. So you don't have any stock which goes too high or low in terms of weightage. And I think the combination of they being steady stocks and the fact that in the long run, both globally as well as India, momentum and low vol are two factors which have done well in the long run. That provides this low vol 30 as a good metric for investors looking at stable large cap investment. So both these, one is a valuation metric, NV20, the other is a price metric, low vol, is a good combination. I think I must credit you for having chosen these two to form a basket. And I think investors, if they invest with patience and have the steady mindset over 5 years, 10 years, they will grow their wealth along with India's growth through these two products. So congratulations for that.
Thank you so much, sir, for those kind words. But my question would be is that who should consider investing in these ETFs?
Sure. So I think all investors, because if you look at it, these are large cap names. Nifty 50 and Nifty 100 is universe. So large cap. So I think from an investor standpoint, any investor who is starting their journey of investing also can start investing. There is no restriction on only the people who understand markets and are very savvy, because this does not have an element of mid cap, small cap. The volatility of these names in general will be lower. Only condition which I would put is you should have a 3 to 5 year view minimum when you are investing, and if you are doing that, then you will get the benefit. In fact, in equities, the longer you can invest is better. And I would also say that anytime that the market falls sharply, please put more money in the market. Don't put money when the market has risen significantly. In March 2020, just when COVID struck, markets corrected significantly, but people run away from the market. That's when you should invest. And today, when markets have done so well, it will be very easy for people to invest. I would say build the portfolio steadily, and that's again where I would probably highlight the importance of an advisor, a financial advisor, to help you, to guide you, make the right choices, not just in terms of where you should invest, but how much and when.
In the post-pandemic era, what changes do you see in the market dynamics, and which sector are you closely following?
So I think pandemic has obviously taught the importance of having your own resources, your own goods and services being produced, because you could practically, even now you can see how difficult it is for goods to move. It's only now that the supply chain is improving. So I think we are taking the right direction, right? We were severely short on semiconductors, and we all use all devices which have semiconductors. So India is moving in that direction where to improve, the supply of semiconductors. We are starting plants in India. It probably should have been done earlier, but the pandemic has pushed us into that. So I think the manufacturing sector, the infrastructure sector, the banking sector, all of these have basically got a fillip, because I think post-COVID era, there is a stimulus environment in which we have lived, and that has led to economy growing. Now there may be a consolidation phase in the next 1 year, but if you ask me which sectors, because of COVID, the car sales dropped significantly, and if you see the numbers for June, July, they've bounced back significantly, and this probably may continue over the next 1 or 2 years as well. Because if you look at India, we sell about 30 lakh cars a year. China sells about 3 crore cars a year, and our populations are almost similar. For the next 10 years, I think there's a good runway of growth for banking, for auto, for practically every sector in India, and we are blessed that we have so many sectors to choose from and invest. And that's where the two products that you've chosen also, they provide you a good sectoral exposure as well across, without you having to pick and choose which sector, how I need to be investing in. So I think India, from a sectoral standpoint, all sectors will grow, because as India is going to grow, because our domestic requirement itself is going to be significant.
Mr. Haria, we are finally at the end of the session. Any informed advice for investors who are looking for passive investments?
Sure. So I think you should first know what all options are available in terms of investing at ICICI Prudential. We have a mission, so to say, to provide all opportunities that you have in terms of investing. I think the silver ETF, which in January, which got launched, we were the first to launch it. In auto ETF also, we were the first to launch. And I think if you look at it closely, we have a passive simplified fact sheet specifically dedicated to the passive section. So I would urge all your viewers, partners, listeners to actually look at the passive simplified fact sheet as well, because that will give you a good idea of all the products that we have. And in terms of advice, it's only one advice. You should have time on your side. You should know when and how to invest, and most important is have an advisor to guide you, because there are so many opportunities available there, but if you don't know where to start, you may end up not reaching the goals which you've set for yourself. Be patient. India is growing. There is money to be made. But if you are in the wrong space at the wrong time, you may hurt yourself and probably never invest again. So that's something which we want people to guard themselves against. Thank you.
So viewers, today we heard from Mr. Chintan Haria about his views on the various aspects of investing in an ETF. I hope it was informative for all. Thank you, Mr. Chintan Haria, for being a part of this session.
Thank you so much. It's always a pleasure. Thank you. Thank you for doing this. Thank you.
Mutual fund investments are subject to market risks. Please read all scheme-related documents carefully before investing.
So friends, I hope that you found the interview with Mr. Chintan Haria highly informative. I would like to share with you all that we have launched the new Smart Beta Basket on the Jiffy application. As discussed in the interview, anybody who wants to invest in the low volatility and the value factors can do so by investing in the Smart Beta Basket. Anybody who wants to invest in the Smart Beta Basket can do so by clicking on the link in the description below.